morning, traders. Welcome to the TMT Stock Market Strategy video for Monday, September 12th. Well, what a day Friday brought in, that's for sure. Big move to the downside. Heavy volume. I'm going to come in and give you guys some really important levels on the daily chart. I'm also going to talk to you about the E-mini S&P. As of right now, we're trading about 13 handles lower. Asia down 2%. Europe right now trading much lower from Friday's low. Could we get a limit down? Yeah, we could. I don't think that's going to happen. We're extremely oversold in the short-term time frames, which I'll show that to you as well. But I just wanted to kind of go over what happened and what's to come. What are we looking at for this week? Now, we had options expiration week that just expired on Friday. It is a bullish bias to the week, and we really didn't go anywhere the whole week until Thursday, Friday. And I mentioned, watch for the rates, guys. The short-term rates are starting to rise. The 10-year was starting to perk its head up, and I showed you an ascending triangle with projection targets, and that is coming to fruition. So I want to show that to you. And really what happened was, and I mentioned again last week, when this all starts to unravel and there's a possible rate hike in the future, actually for the September FOMC meeting, which I don't know if they are going to raise rates or not. Even if they did, it would be a definite market shock on top of what we just had on Friday. So I would suspect that they don't want to rattle the markets coming into an election year. The election is like 6 weeks away, so I would suspect that they don't. But I do think that they probably have to raise in December. With bonds getting crushed, literally crushed. And we mentioned, well, why would bonds and precious metal go down and along with the equity markets? Well, because they all rose at the same time, right? They all went up. Bonds went up, gold went up, precious metal, oil went up, and equity markets went up. And I said, somebody's going to be wrong here in a big way. And usually the bond guys are the smartest guys in the room. And we had market highs in bonds at one point this year because of, again, the Fed pushing bonds lower, excuse me, rates lower and bonds higher. And as you know, it's inversely correlated. Now, when rates can't go any lower, I mean, they can go negative, but I mentioned months and months. I said I do think that rates have bottomed. You're going to see a generational low in rates. And it does take time. A bottoming and topping are process. It's a process. It's going to take a little time. But if you see what I was talking about, I could piece it together. You can see what was to come. Now, yes, Friday's big down day, guys. Don't be upset if you didn't do anything. To me personally, even as a day trader, if you're not coming in short, number one, you're going to open up, you're going to gap down lower, and then the market just literally just melted lower with very little, tiny little bounces, which the risk reward really wasn't there. So it's not a big deal. There's plenty of room to the downside if this were to continue. So we're going to see the next couple of days are going to be critical. I'm going to show you my thoughts. Let's get right to the charts. As you can see here is the VIX. You can see what a massive explosion we had here in the VIX. Big move up almost 5% in one day, and that's what I mentioned. Watch this, and there's a ton of shorts here, guys. Remember, the commitment to trade reports have this at the most extreme short interest since this index or asset class was created. The volatility index was created. So there's a ton of shorts that have to cover. This could explode easily up to $27, really screaming and killing the shorts here. And that's why I would say never, ever be short volatility unless you're somewhere up in these areas and outside the band. Okay, so this is something that could move extremely fast back to the upside. So I would be definitely paying attention to what the VIX is going to be doing here. Next, I want to show you some volatility, another measurement about volatility. You can see we're extremely low here, even though we're at 15.5 in the ATR versus the S&P. We have plenty of room to run to the upside before this gets to be somewhere where washout levels where I'm looking for a bounce. Okay, now one day when you have a big move like that, when you have a big move in the S&P, you usually get some sort of a dead cat bounce or retracement rally. Right now, we have not seen that early in the Monday morning hours. So what's the culprit here? Rates. And you can see here is a 2-year. I just want to show you the significance. Here's this 2-year where we topped out last summer, and look what happened. Just rates just literally really disintegrated all year long, and sure enough, bam, we just broke out of this descending trend line. So now look for, I would say, stair step, bull flag, and rates to climb up again. And that's the 2 year. Let me show you what I've shown you for the last several weeks is this 10 year. Okay, so here's the 10-year yield, and you can see we have an ascending triangle. If you recall, I had an inverted head and shoulders, which really didn't pan out, and the reason why is because we went sideways for pretty much all of August. So that was a little bit longitude. So we had another pattern, and this is where I show you this in the premiere video, guys. You'll see these in the premiere video, and what I'm showing you and keeping you guys alert of what's to possibly come and actually trade. So you can see here our target off the ascending triangle comes in at 185, okay, on the 10-year. Okay, so you can also look at the TNX and divide that by 10. That would get you the same here if you don't have the feed for the 10-year. What happens when the yields rise? Here's the TLT, and I mentioned that to you before. I shown you this. You could see lots and lots of distribution here. Okay, this came off of Thursday. Here's Friday. Here's this morning already a tick. And here's my first projected target of 38%. And again, in the premiere video, we put intraday charts for levels that you can trade, because when we get into a market that's moving, I want to show that to the subscribers. Anyway, 38%. You got that thin zone here too, and I mentioned, so we should wash right down to the 134 easily. Okay, if not the 200 of the 132, and then again we would reevaluate it. Okay. Next is going to be the GLD. And now GLD is going to be tricky. Now we usually come into some seasonal strength right now going into October. Uh, but I'm actually a better buyer than a seller, but not at these levels at all. I want to see a washout down to this double top area of 120.50. Okay, you saw that already before. I mentioned this to you many times. You can see that our RSI and MACD are unwinding, and I like to see a big washout, and gold usually does that. If we take out in the GC contract 1300 to 1304, we'll wash back down to that 1260 to 1280, and that's going to interest me in being a better buyer in the gold contract, the GC contract. Okay, here's the GDX, and here's the last time we had our projected targets hit, and now we're coming back down. I mentioned here, look out for a gap fill. We didn't even get that far, and we started to sell off again. So I'm looking for a washout, possibly even into this zone area back in March, early April, before we took this another leg higher. I do think that gold is in a second stage bull market, but again, has to wash out all of these weak longs before you get back in it again. Okay, you could actually see gold go even lower, and that's the GDX. All right, so let's go right into the spiders. You can see here, guys, like I mentioned, we had dollar increments in the spiders, 17 and a half, 16 and a half, 15 and 14 and a half. Well, we took that out in one day. Look at the distribution candle here, the volume bar. Heavy distribution. That's one day. This is a 1 week coming back off of the holiday week and the end of the summer. And remember, there's a lot of bigger traders and managers that haven't even gotten to their desk yet. Okay, so and now we took out the 21 and the 50-day moving average. They're significant. This to me is the start of a new downtrend. Okay, now it doesn't mean that we're meaning at the end of a bull market, at least not yet. There's just not enough evidence. Don't listen to anybody that we're starting a bear market here. Not even close. One day doesn't make a trend, so I will tell you that. But it's nice to see some pullbacks, because the pullbacks will reset a lot of these overbought readings that you have, and then could actually start another leg higher and make new highs at one point towards the end of the year. But right now, to coming off of the Brexit lows and rallying this far, gap up almost every day, and then go 2 months sideways, it needs a pullback, it needs a rest, and it's healthy for the markets to do so. But in the meantime, back to the markets here. I mentioned that for weeks now, the 210 to me is going to be the probably the projected target for this pullback. Now, usually, okay, usually the markets, a big down day like this usually retraces back 38 to 50% of this candle's move. Okay, so keep that in mind. It does not have to happen, guys. Like we did last August, we sold off pretty hard, and also like we did in January, we took one down candle. That was the start of a short-term decline. That could happen. That could get us here to the 210, and by the end of the week, if not the 200-day moving average, which would be the 50% retracement here off of the Brexit low. Okay, so and I had another email. Why do you take it off of this low and not the low down here from back in February? Well, because this is the current low here, and I want to see what the current from the high to low, what the pullback is. And if you look at a lot of these retracements coincide beautifully where prices You can see here's a 200. Here's where price hit again, and here's that 61.8% retracement, and here's a 76.8% retracement, and this coincides nicely with these gaps. So these are true and real, so pay attention to them. This is something of significance. Next is going to be that 60-minute. Here's just a 60-minute chart I wanted to show you with the premier video, guys. Take a look. If you're looking for areas to trade, levels where are actionable, the premier video will definitely help you guys. Not a question. And here is the high to low Fibonacci retracement, okay, off of the Brexit gap up, okay, and you could see here we had the rising bearish rising wedge, which target was hit last week, excuse me, 2 weeks ago, and now we have this big move lower. The next area would be 211.48. Okay, 211.48 in the spiders, and then ultimately the next level would be 210. 211.48, 210. Now I want to give you some levels here in the S&P. Okay, if you're not trading spiders, looking for any downside targets right around 2080 to 2085. Okay, and resistance on any type of bounce will probably be about 2130 to 2135. That's going to be in the S&P. Okay, 2130, 2135. If it holds, okay, if it holds 2135, look to sell that rally. Now, if we get back above the low of 2150, the previous day's low, which I don't have here in the chart, then that was just, to me, basically, that was just a one-hit wonder, and then we go back to challenge the highs again. So 2157, 2155 is going to be key. If we break back above it and we continue, then we're going to go to at least challenge the highs. All right? That's going to be the targets to the upside. Here's the transports. And here's, you had a big move here 3-4 days based on the airlines moving higher. And like I said, I treat this as suspect. Yeah, they did hold in pretty well, but we're back below this area of this horizontal area of resistance, which was support, and we're clinging to the 50-day moving average. So let's see what happens today in the transports. Just want to show that to you. IWM daily, looking for a 118.80 print. Okay, that's coming off of this peak. All right, that's a 38% retracement to 116.70. Okay, that's going to be your next target in the IWM. And lastly is going to be the Qs. We took out that key pivotal support area of 116.15. We took down the proprietary price channel, and of course the next target is going to be 112. 112 is going to be the bigger target in the Qs daily. So pay attention to that, guys. And remember, we could bounce. Pay attention to the bounce today if we do get one. Okay, no one knows if we are going to get one, but if we do get a bounce today, if the bounce is lethargic with no volume, that's going to be your cue to look to get short the market again. Okay, but let's take it one step at a time before we get aggressively short or aggressively long, for that matter. Have a great day. We'll see you tomorrow.